First, let's look at the currency, where we saw the Kenyan shilling close flat against the dollar at 83.80.84, barely changed from Monday's close of 83.90.84. This is expected to weaken after policymakers slashed the central bank rate by 100 basis points to 8.5%. In the stock market, the benchmark NSE 20 share index extended a 5-day run to close at 4,881.75 points, which was 0.7% higher, while the all-share index added 0.8% to stand at 121.95 points. Our market watcher for the day is Samuel Gichohi, the Business Development Manager for NIC Securities. Thank you for joining us.
You're welcome.
So the 100 basis point slash on the central bank rate did not come as a surprise to you. Why is that?
Well, not really. Inflation is still below the 5% mark, and we think that it's still in the interest of the government to spur lending, and the only way that they can signal this is through the MPC, which is the only benchmark rate that they can use to try and spur banks to begin lowering their interest rates. And as a result, we can expect to see now the banks also, if they do bring down their interest rates, then that will spur lending, and if it spurs lending, then it will help also to bring out investment in the economy. So we were looking at it from that point of view, and it is really a policy issue where they feel that increasing interest rates right now is really going to quash quash investment. At the same time, it is a point, at this point in time, we are still below the 5% inflation rate.
We are. We are at
so as long as we're below that, I think lower interest rates are the order.
Do you see the banks following suit with lower rates?
Well, it's usually sticky upwards, so it might take some time. We might see, but they're usually reluctant until they see that that sort of rate is going to be sustained for a long, a period of time. So we can expect there to be a bit of a lag, but eventually, yes, they will begin to come down.
In terms of the interest rates, whereby we saw banks also recording very high margins on their loans, and now this is expected to reverse as the policy starts feeding into the economy. How do you see the performance of banks being affected as we go forward, second, third, and fourth quarter?
Well, one thing is the spread, because one thing is as the interest rates come down, there's, as I said, they're sticky upwards, so banks will sometimes gain a little more before they bring down the interest rates, because then they're actually getting a larger spread. And then when they do bring them down, what happens is that spurs lending, and lending being their core business, then that naturally increases their revenues and naturally increases their earnings. So I think it's not really going to affect them per se, because as long as the spread remains, then they're not really. So they
capitalize on volumes and less non-performing loans.
Yes, absolutely.
All right, looking at KCB, they're announcing their first quarter results today. One of the biggest banks in terms of assets in the country. What are your sentiments on their performance?
Well, we've seen double-digit growth equity, we've seen double-digit growth housing finance, we've seen double-digit growth of Kenya Re, although it's not necessarily a bank. So I think we are expecting double-digit growth across the banking sector, and KCB and Equity, and I think Barclays will tend to be, they're the big boys, and they tend to be, the two locally run, Equity and KCB have continuously shown, to be at around the same level. So I do expect that KCB are going to come out with a double-digit.
We have seen KCB in the past really embarking on, massive cost cutting, going through McKinsey Global, and we have also seen it feeding into their cost-to-income ratio. Where would you rate it?
Well, I think KCB will still be on top, but Equity did see a decline in their interest expense, and that I think also helped them to show that increase. So the cost of lending will come into play here. As interest rates shift, then that will be a major area to watch. I think the costs will definitely come in, but I think that has already been factored in, and we saw that in the last results. But I still expect them to do quite well. Yeah.
Still on the track of interest rates and banks and loans, and the fact that we are likely to see it becoming affordable to lend. For sectors that are likely to also benefit, you look at real estate, you're looking at Bamburi, and also the Athi River ARM cement. How do you see some of those stocks performing?
Well, I think one thing that we're going to see, the real estate sector will really benefit, because I think that sector suffered the most, really, with interest rates going up and them having to service loans at a more expensive rate. Definitely had a slowdown effect on real estate. So I think we can expect to see that sector begin to revamp and begin to recover. And with that, then I do expect that we are also going to see a lot of infrastructure spend, considering that now somebody like Bamburi usually gains a lot from government projects, and those government projects, and I think the county projects now, are going to come into play here, because I think most of our governors don't have offices, the road network is still being developed, etc. And we have seen this government, really show that they expect to continue with that huge infrastructure spend that we have seen in the past. So I do expect that, Athi River Mining, Bamburi, East Africa Portland, the cement companies will definitely gain from. So
we'll also need to keep an eye also on the debt market. Today's sale and next and then tomorrow's sale.
Absolutely, absolutely. We might see some investors trying to lock in, those interest rates. But then again, there's a negative correlation between interest rates and the value of debt instruments. So therefore, we're also probably going to see an increase on the secondary market of trading of those securities going forward, and therefore we'll be watching that market keenly.
All right.